Sorry. Thank you, Paul. And so we'll jump into item 10 and just for for the public, I realize we're jumping around the agenda. One of our goals for Harry and I moving into next year as chair and vice chair of the board is we're trying to work hard to reorganize our agendas and line them up so that we have our beefiest topics when we are the most, I don't know, what's the nice way to say it? When we're the sharpest, when we are the most, not that we're not sharp and alert in other times of the day, but we're working really hard also to accommodate board members. And I think moving into July and the next fiscal year, I think we're going to be in a great place for next year. So we're just in the transition, if you will. So item 10?
Yep. Let me introduce Stephen, and Josh is getting his slides up real quick. Good news. Last month in February, we told you you're going to have to pick between the consultants. We realized that's not going to work because staff couldn't pick between them. So we're going to run with the two of them parallel. And I'm going to probably steal Josh's whole slide deck by doing this. If you turn to INV 30, the table there gives you kind of what we're going to talk about today. They have two different lists of asset classes, but we're going to let them run forward with it. They're going to explain those to you, the pros and cons. I would encourage you to ask them what asset classes they're leaving off. What are they blocking or not including in their asset allocation, as well as why they're including those. And then lastly, I draw your attention to, where'd it go? INV. Kind of was my favorite page in this deck. Now I can't find it. My darn tabs have moved. There it is. Sorry. INV 39. This was in the memo. So we often talk about, I talk about Ohio PERS, Faruqi Majid, but you can see the enormous amount of asset classes they use. Also look at Arizona SERS, a massive amount of sub-asset categories. My favorite one that I wanted to highlight is you hear about Ontario teachers all the time. Everybody holds Ontario teachers in this just utter respect. Look at their cash allocation. So that means that negative 25%, they leverage. So they're 125% leveraged. That's partly why they outperform, is they take risk at the total fund. So in our case, that'd be an extra $50 billion we'd be investing and borrowing money from somebody to do. So kind of an interesting asset allocation. So we're all set. With that, I'm going to introduce Josh and let him take it over from there. I'll introduce Stephen.
Okay. Thank you, Chris, for the introduction. Today, I just wanted to sort of lay the background in terms of how we're going to proceed. So in just a couple of minutes, Josh will lead off with just about 5 minutes. He has a slide deck of 3 slides. And then I'll kick it off to Makita, and they'll spend about 10 to 15 minutes on their slide deck. And then last but not least is PCA, and they'll spend about another 10 or 15 minutes. The main takeaway today is what we're going to try to work on, identifying what asset classes will go into the modeling process. So certainly you'll hear views from Makita as well as PCA. And so one of the things that I'd like you to pay attention to is not only what, but understand what is the role of these asset classes. That's also important in the discussion. So with that, I'll kick it off to Josh.
Thank you, Stephen. So actually, Chris did steal my thunder. I had three slides, but actually in the interest of time, I was going to cut it down to one, and he pretty much hit on the one, which was, we took your feedback from February when we were talking about the project timeline and then our internal discussions, and really decided that the best way to go would be to keep the consultants in parallel. So what you'll see today will be their approaches to the asset classes and how they look at it. And then going forward, we'll continue on that parallel track where in June they'll come back with capital markets assumptions using their asset classes. And so this is really a discussion of the classes, and then we'll continue everything sort of in parallel instead of having them collapse into sort of a single set of asset classes. And the other 2 slides I had, I think we'll save. We can come back with those in June. We don't need to necessarily talk about them today, and in the interest of time to get Makita and PCA going.
Appreciate it.
So in the interest of March Madness, we're doing another sports analogy. We're doing a possession arrow, and who gets to go first each time. Last time it was Alan, so this time possession arrow is in favor of Makita, and they get to go first. If you want to bring up their slides, pass down the remote control. So we'll make room for Mika. Alan already got a chair. He thought ahead.
Okay, let's see if I can get back to beginning of our presentation. As Stephen and Chris relayed, this is now an informational item, so we're not planning to spend a lot of time on the details here, but we did want to give you a sense of how we view asset classes. Now we think about, more importantly, modeling asset allocation policy. Slide 1 of our presentation shows the rough 5-step process that you have to enact asset allocation policy. Today's presentations relate only to the very first of those 5 steps, which is reviewing the asset classes that are being modeled on your behalf. And as Stephen mentioned, there's some modest differences between the types and numbers of asset classes that Makita will be modeling and the types and number of asset classes that PCA will be modeling. So the most important part of the analysis is determining how many and what types of asset classes to model. And in answering this question, we go through a number of sort of fundamental characteristics that we look at. First of all, an asset class must be investable and have characteristics that make it attractive for long-term investment. All of the asset classes that we model, we have to be prepared to recommend that funds invest in. Secondly, asset classes must have reasonably distinguishable risk, return, and correlation characteristics. We want to make sure that the asset classes that we're modeling have a likelihood of zigging and zagging at different times to provide at least some modest diversification benefits. Some institutional pension funds must allocate at least 5% of their total portfolio to the asset class. We think there's some wisdom in the work that other funds have done globally on asset allocation. And so we look to a certain extent to the work that other groups have done in identifying asset classes that they deem investable. Importantly for you, the asset class must be of sufficient size and of sufficient liquidity for a fund of your size to invest in. And finally, we model cash because even though cash doesn't necessarily comply with some of the above characteristics, because it is a liquidity pool and in essence a default investment for you.
Great. So on slide 3, we walk through, On slide 3, we walk through the 13 asset classes that Makita plans to model for the asset liability study. And we've grouped them into what we'd consider kind of overarching risk factors, which I don't think is that different from what you look at today when you consider your asset allocation in broader buckets.
Mika, do you mind if I just jump in? And I've got Tom. So
Sure.
do you mind if...
So my question is, does this reflect on some level the assets that we're in fact invested in now? So we have private debt, which is something we haven't talked about before, and things like that.
Yeah, so that's actually a great point and one of the main points that I was going to make. And I think what staff distinguishes in the memo between Makita's structure and PCA's structure, currently the board and the investment committee use really a 2-step process. So you set these broad targets to say global equity. Then you have asset class policies that allow for investment in underlying pieces. So private debt comprises within your private equity component, other areas like that. And you have allocations that are acceptable, and then staff has discretion to make investments there. So you have all of those risks in your portfolio. From our perspective, by modeling them out and considering them at least as a potential to include in that first stage where you're allocating targets, you get a better sense for where the risk in your portfolio comes from. At the end of the day, you can't have any better ability to predict your future returns, I don't think. I'm not sure the modeling process, I'd argue, gives you a better sense for what your return outcome will be. But I would argue that you get a better sense by modeling more asset classes what the risks in your portfolio are. And since that's something we can better predict out to the future, some boards are more comfortable identifying those and setting strategic targets to those in the first stage. But that's a great question. The other, I know that staff also noted in their memo, of these asset classes that you see, all of them, to Tom's point, are included within your portfolio to some degree. I think the one that's maybe the least utilized today is emerging markets debt. You may have a few active managers that have exposure there, but really no kind of structure in place to target your fixed income team looking to that area. So that might be one area that when we model out the risk and reward trade-off of that asset class, it looks a little bit different than some of the other areas you've looked at. To Chris's point earlier on what don't we model, because there's obviously a huge list of potential asset classes. A few of the areas that you don't see here, because you could get down to a very, very granular level if you allowed it to go that far. We're trying to look at, as Steve mentioned, asset classes that, one, you can invest in. So for instance, something like frontier markets, which we do have unique expectations for compared to emerging market equities. It's such a small universe today of investable assets. And so many of the growth drivers come from the same places that emerging market equity growth drivers come from. It really, for your portfolio, isn't likely beneficial to model that separately, to set strategic asset allocation separately. It's something that you may opportunistically invest in through active management in the future, but I'm not sure it really adds value to the process. Another example might be something like GTAA, which you see on some of the other large public fund asset allocation lists. I'd argue that that's pretty difficult to call.
Yeah, you might.
So it's a global, it's a tactical asset allocation product, and that's really how we consider it. So it's because ultimately what you're doing in that space is allowing managers the ability to tactically invest in a variety of asset classes. I'd argue that's the opposite of being able to set a strategic target where you can know what the risk and return expectation is, because it could be very heavily weighted towards equities one year and very heavily weighted towards fixed income in another year. So it makes it really difficult to know where the drivers of that performance is. It's not to say some of those strategies can't add value, but from a modeling perspective, it's really difficult to pinpoint where that risk is coming from.
Yeah, the other question in your modeling approach is, how will you treat our kind of off-the-run portfolio assets, as you, if you will, our governance portfolio, the minority managers program, and things like that?
Yeah, it's a very good question. We at the next meeting will be sort of setting expectations and working with staff to determine to what extent the expectations for those types of allocations should differ from broader market expectations.
And they would fit into one of the asset
They would, yes.
classes, and you'd adjust the return expectation.
Exactly.
And will you be explicit to us? I'm not sure whether I want to know or not, but as to the impact of on your work?
Sure. Yeah, absolutely.
Okay.
Harry?
In your modeling, when you look at this and it all comes to us like this, are there assumptions around growth models that you think about in terms of what Makita pushes into a system as to what you expect GDP growth to be, and as a result of what those ranges are, helps frame what you bring to us? And if yes, what do those ranges in GDP growth look like, and if not, why not?
Yeah, the factors such as GDP growth or the level of interest rates or expected inflation play into the expectations of risk and return for all of the asset classes. And at the next meeting, when we talk about expectations, that's largely what we're going to be focusing on then. And so without making sort of the response overly long, we'll be discussing that in detail at the next meeting.
Terrific.
For the purposes of this presentation here, we have categorized the asset classes that we're modeling by the major risk factors that impact them positively or negatively, whether it be GDP growth or interest rates or inflation.
Thank you.
So that was sort of the question so the reason, I just wanted to, on kind of brass tacks, understand the reason why you're pulling out into 13 asset classes is to better measure risk. Is that an accurate
That-
statement?
That's right. Just to give you a sense, if you believe that emerging market equities have distinct risk and return drivers than U.S. equities, modeling the forecasted expectations at this level will allow you to better set an allocation to emerging market equities vis-a-vis U.S. equities than dealing with it at the asset class level, and at which level you're only contemplating the correlation between emerging market equities and other types of global equities. So the more asset classes you choose to model at this level, the more detailed you're able to get in modeling the risk of the portfolio. The reason you don't include 50 asset classes, and we actually have expectations for 50 if you care to do that, is at some level you have to make a judgment that there's false precision in the data and in using more asset classes. If you're not likely to allocate assets at the asset class level to incrementally smaller and smaller slices of the capital markets, then there's not much value in modeling those. So we make a judgment,
Where's the threshold of
where
value?
the threshold is. And the other thing I want to highlight here is these are the asset classes that we intend to model. At the end of the day, we may choose to present you with policy portfolios that include or exclude certain subsets of these. Not all of them necessarily are going to be attractive based on our risk and return assumptions. Also, after you model them and select policy portfolios, you may choose still to treat bundles of them as a asset allocation target. So you could still bundle U.S., international, and emerging market equities into a global allocation bucket, but that bucket may not represent the 2/3 U.S., 1/3 ex-U.S. that it does now. And so to Mika's point, really what in your governance structure, what this does is it brings a lot of the decisions that you were making at the asset class level up to the asset allocation level.
Got it. Harry?
So with the number of asset classes that you currently have in your model, what is the equity-like exposure risk in all of those asset classes?
In the aggregate, it's going to be 80% plus on a risk budgeting basis. More than 80% of your volatility is going to be driven by your equity allocation.
So my point is that there's more asset classes here, but in the traditional asset classes that we've looked at, if I'm correct, the equity-like exposure in those fewer asset classes still are around 85%.
That's right, yeah.
So this is just more asset classes, but it's similar to the equity-like exposure risk we're taking.
Yeah. The using more asset classes to model won't necessarily mean that you reduce or change your risk profile at all.
Right.
Ideally, it means you'll have a somewhat better sense of the types of risks that you're taking.
It's essentially the same picture, but we're looking at different frames, more frames,
More pixels.
more pixels. Yeah.
More pixels?
Yeah, more pixels.
Paul?
But the idea is that you get a better sense of risk because the different subgroups don't necessarily act the way of the whole from a risk
That's right.
standpoint. But I want to get back to the false precision question because it seems to me to be the real question here. In theory, modeling more asset classes is a good idea if the precision of our data is as good as if we have a smaller number of asset classes. So do we have any historical experience to tell us whether in the past there's been similar precision in looking at a larger number of asset classes relative to a smaller number of asset classes?
The answer depends on which asset classes you're looking at. For example, high yield bonds. If you are willing to look back beyond sort of the development of original issue high yield bonds in the 80s, fallen angels have performance track records going back to 1926, and so. High yield bonds would be a separate asset class here that would be modeled, and I would argue that you have a pretty strong precision on that asset class in terms of how it behaves vis-a-vis other asset classes in different economic environments. You have other asset classes, and I think probably the best one is the one we heard from this morning, infrastructure, which is new to everybody. And so when you're modeling out expectations for that, you're necessarily going to have less confidence in the expectations that you do have. But one has to make a judgment that the expectations that you can develop on return, risk, and correlations are precise enough to model and provide meaningful value in the context of diversifying the overall portfolio. Slide 4 just shows an efficient frontier, perhaps one of 3,650 you might see in the next few meetings from us and PCA. This is just a mathematical abstract. We talked before about the rationale for modeling more asset classes is that you get a more granular picture of risk. And in a mathematical context, what that means is that as long as the asset classes have a correlation of less than 1, you have the potential to end up with a portfolio that's more efficient. As I mentioned before, if we had a line here representing 50 asset classes, it would yet still look better than the 13 asset classes. But at some level, you have to make a judgment that the modeling process is including asset classes that you have a reasonable degree of confidence and precision in. And for us, 13 is where we ended up for your portfolio.
So next, staff asked us to highlight, and I think this is a really key point, kind of the disadvantages and advantages of modeling more or less asset classes. All of the questions have sort of led to the next couple of slides. So I really think that I can distill slide 5 into kind of one phrase, which is the biggest disadvantage is more numbers. It's more numbers that you'll see in the asset allocation process, more expected return numbers, more standard deviation numbers, more potential outcomes then, right? So for every asset allocation, when you look at expectations under simulation, the more asset classes you have, the more the outcomes change. And so it's just as an investment committee, it's more numbers to digest. And I think that's really the biggest disadvantage to having more asset classes. That being said, to some of the questions we had earlier, you already are taking a lot of these risks in your portfolio simply in that second layer. And so I'd argue that this is just moving your additional layer of complexity into the first stage of the process, as opposed to adding a layer of complexity that you don't have already. One other piece, and this is a more meaningful thing to note as far as a disadvantage, is that you do have, from a tactical asset allocation perspective, where staff has some discretion to move assets around, as well as from a rebalancing perspective. If you do, for instance, as Steve mentioned, at the end of this process, you could look at the models for US equity and emerging market equity and decide you still want global equity with one target, or you could have a distinct target of 20% to US equity and 5% to emerging market equity. If you choose the latter and you have a distinct asset allocation target, that would necessarily have a target range around it, and it would mean that there's rebalancing that necessarily takes place, whereas today, staff has more ability, I think, to look at the relative comparison of what US and emerging markets are doing and deciding how to rebalance assets in line with that.
Tom?
Okay. I heard what you say. The advantage I've been seeing is that it brings all of our conversations about equity, for example, into one set of discussions. We talk about asset allocation, and we haven't regularized as a board yet the review periodically of our policies about equity and our ranges about equity. And rather than institutionalize a two-step process to do that, that was the advantage I saw. As you talked, I got a little confused that might not be the case, but.
No, I think that's right. I think it would basically, the board would be setting that strategic target earlier on, earlier on in the process. So I think that's exactly right. I'm sorry if I.
Yeah, well, I think the thing is, we don't have a two-step process. I don't think, since I've been on the board, we've ever reviewed the policy about equity investments and the range is there. So, so you are bringing it into one, yeah.
And then the only other thing that I would note on this slide is simply the potential staffing implications. So obviously, if you do add a strategic target to say high yield bonds and that it increases your exposure at the asset allocation level, that might have an impact on staff members, et cetera.
Joy has a question.
Yeah, so the comment that you made about how a more granular asset allocation, what the implications are for our tactical asset allocation and rebalancing, does that make us less nimble if there were to be a crisis or situation that warranted making some changes within the ranges, or do you not anticipate that would be an issue?
I think at least my experience has been with clients that have a more granular policy, as long as you have ranges around each of those asset classes, it doesn't change your ability to be nimble. It adds a layer of reporting from staff to you on kind of what they're doing within those and where you exist. But if you set ranges appropriately, I think you can account for possibilities in the market.
Still allows flexibility.
Exactly.
Okay.
On page 6, I just wanted to highlight what you've already talked about a few times, is that modeling more asset classes doesn't necessarily mean you end up with a better portfolio than managing fewer asset classes. And just by way of example, Makita tends to be a supporter of higher emerging market equity allocations than you have today. And in the asset allocation process that we're doing, we'll sort of highlight the advantages and risks of that. But if we were to model global equity and not its components at this level, we'd still be equal advocates at the equity asset class level. So really, modeling these numbers of asset classes really just gives us a better chance of coming up with what we think are more realistic behaviors of your portfolio under different types of economic scenarios that could exist.
I don't really think that we need to spend, slide 7's been mentioned by Chris and by others. This is simply to provide you with a comparison of a few other large public funds and just to show that there's really no one industry practice where it comes to asset allocation. Some plans use fewer asset allocation targets and asset classes, and some use many. When you look at Ohio and Arizona, they sort of expand down into even looking at large cap and small cap equities with explicit targets. So again, you can allow yourself to get as granular as you want, but I think the important thing is to figure out what's right for your board and what type of risks you want to think about.
The one thing I wanted to note on this slide, and the main reason we included it was just to show you the diversity in asset allocation policy. None of these clients, Makita Investment Group, advises on asset allocation. They all have different consultants, different staffs, and they all come up with very different results. And I think they're all thoughtful, and they all have their own theories that they're working off of. What I want to highlight as well, though, is that this is perhaps in our industry the most significant change we've seen over the last decade is the increased diversity in the way that funds approach asset allocation. I think if you were to look at a similar slide 10, 15 years ago, there'd be much more uniformity across asset allocation and plans. And so we'll know in 20 years which one's right, but as we see today, we don't.
Barry.
So Stephen, those changes, I guess for me, the real, it's possible that and it's likely that I'm missing something. For me, the concern is more the equity-like exposure to risks that are in these portfolios. So I'm not as much concerned if there's 5, 15, or 20 classes, but if they all have similar risk profiles and exposure, that's kind of more of what is I want to understand. And if there's a fund that has maybe a similar amount of asset classes, say, that we do, but their risk profile is different, then their outcomes are probably going to be different. Is that line of thinking correct?
And we can actually do that analysis as part of this project with you, and it'd be interesting to see if you think of equity risk broadly in a world where interest rates are where they are and forward-looking bond returns are not under dispute by anyone, any U.S. pension plan that's looking to achieve a 7 to 8% return is going to have very similar levels of overall equity risk, 80 to 90%. Mathematically, that's the only way to get an expected return up to where you need it. What you will see a lot more difference in is within equities, what types of risks are you taking, U.S. versus international? You guys have hugely benefited relative to peers in that respect over the last 5 years. The other big difference, which could be more meaningful in the future, is how opportunistic or fluid some of these plans are with respect to changing allocations. Your model right now is very much sort of a strategic, long-term buy and hold model. We increasingly see funds, and you look at Arizona on my far right, with up to 15% of the portfolio that's fully opportunistic, where they can invest in what are, at the end of the day, relatively short-term opportunities that they see in the marketplace that aren't buy and hold. So again, we don't know if that's a better way to go about things or not, but that's another big difference we see across funds emerging.
Has it been, maybe traditionally is not the correct term, maybe I'll make my point anyway, but have pension funds traditionally had asset class allocations and risk profiles that are underlying dependent upon, to receive those types of returns that we receive, dependent upon a certain GDP number, a growth model, and that's really kind of, if you get in that type of growth, you're going to generate those types of, you're going to take those types of risks and get those types of return. And if the GDP numbers are not what you forecast them to be, that's where you start to have some challenges.
Over the very long term, that is true. I would caution you that there's not any meaningful connection in the short term between GDP growth rates and market returns, mostly because the market fully discounts forward-looking expectations already. So what really matters, and you'll hear this a lot from us during this process, is not what the level of GDP growth is in the US or Europe or Japan or the emerging markets over the next 20 years. It's what the level of GDP growth is relative to what the market is already pricing into those securities today. So it's surprises in GDP growth that really move markets, and it's the surprises that are really the risk factors to your portfolio.
Thanks.
Any other questions?
Our final slide is slide 8, and we just include this for information. We'll talk at the next meeting, as I mentioned, about our specific risk and return expectations and how we develop those. But this is a preview of that, where the 13 asset classes reside on a risk and return chart. And again, you'll see lots more charts like this from us.
Yeah, I just wanted to follow up on your answer to Harry's question, because I didn't really understand it. Are you saying that if the market didn't guess wrong about the future growth in GDP, that the market wouldn't move at all? I mean, you seem to suggest that the only reason the market moves up is because the GDP grows faster than the market thought it was going to move.
So the GDP is just one of many factors that drive the market, other factors being things like liquidity, public policy, investor psychology. But let's focus on GDP growth for the moment. The market today, through the tens of thousands or hundreds of thousands of investors, price every security based on a forward-looking earnings expectation.
Right.
That forward-looking earnings expectation, in turn, is based at the aggregated level on a level of GDP growth that investors either explicitly or implicitly assume the that the U.S. economy is going to generate over the next 10 to 20 years. So what moves stock prices, all else equal, and there's a lot else you have to hold equal, what moves stock prices is not GDP growth being lower over the next 20 years than it was over the last 20 years, but rather GDP growth being lower than what the market expects it to be. Now, so the judgment you have to make if you want to assume that the market is over or underpriced is is the market today pricing in GDP growth that is too high or too low versus reasonable expectations? We certainly believe that GDP growth in the U.S. is much more likely to be lower over the next 20 years than it has been over the last 20 years. We also see that the U.S. market is at near record high valuations. So if you assume that investors tend to assume the future repeats the past, and you, as a consequence, believe that investors are pricing in GDP growth that's higher than what the market is likely to see, then that would advocate for U.S. market returns being lower than what they have been historically.
Okay. Except in the very long run, then okay. But that's. And are we looking at the very long run, or are we in our modeling, or are we not looking at the very long run?
We're looking at a 20-year time frame, which, depending on your definition, could be the very long run or may not be. But the other variable in that, of course, is the connection between corporate earnings and GDP growth, which isn't perfect, as I alluded to before.
Great. Thanks. I don't see any other questions from the committee. So, Mr.
Shifts it
Emken.
over to PCA. Slide over and.
Okay.
Bill and team, John?
We have 8 minutes.
Well,
No. We can do it in 8
well,
minutes.
I have full confidence that you can.
Because I assumed that you read the voluminous amounts of material that
We
were
actually
presented, so there's
like
no
I say, we
reason.
do our homework on this board, so
And-
yes.
Our background paper goes into great depth on some of these issues. We really just want to hit you with a couple of concepts. And the key to our whole presentation is this quote from Julia Child. It's not very
Correct. I
often
did note
I
that
get to quote a famous chef and cook, but we looked for some way to help make sense of what we're doing and our thinking. And we found that this quote really reflects our thinking better than almost anything. And that is, it doesn't have to be too complicated. But there's two things. You need really good ingredients, and they need to be fresh. In this case, it's fresh ideas. And what we're trying to do is do it a little bit differently than people have done it in the past. And it's not right or wrong, right? And you chose to have divergent opinions, and that's good. It gives you something to choose from. So we're going to give you something that's different, and it gives you something to weigh. And we do come out differently than our friends at Makita. And the key to the difference is what we're really trying to do is to focus on assets meeting of objectives, because at the end of the day, what you really care about is funding a pension plan over a long period of time at a given level of risk. How do you get there? And in our opinion, that's by putting groups of assets which perform in a similar manner in risk-return space and putting them into groups. And that means you have fewer groups as opposed to more groups, and that every allocation should be meaningful. And that when I started doing this in 1983, we would use a Markowitz optimizer, and we would put 20 or 25 different asset classes or sub-asset classes into an optimizer and go out to 2 decimal points. People thought we were really smart. Well, the reality was I didn't know what I was doing. And I don't think that was unique to me. That was the whole industry. We thought an optimizer could solve everybody's problem. What I've learned over 30 years in the business is you better be really humble about what you know and what you don't know. And so the more assumptions you put into the model, the greater the potential is you'll be wrong. And so we try to have fewer assumptions, and that way we'll minimize our ability to be wrong. What I'm going to do is shift it over to Neil, who's almost going to go to the end of the presentation to tell you where we end up. And then John, very, very quickly, to talk about a different way we're looking at a part of the portfolio.
Okay. Just a couple of responses. I think Mr. Kiley's points on what are you trying to identify. Equity risk is a big deal. Sometimes it's important to know how much you have. Sometimes when you have a lot of things that you're thinking about policy-wise, you might lose sight of that. Makita talked about bringing the complexity up. I think the philosophical difference is we're trying to keep the complexity relatively low at the policy level so that you're focusing on the big risk issues like growth risk and how you deal with that.
I have Tom jump in. Yep.
Sure.
I mean, I have a feeling we're talking about a difference that, with respect to equities, that is, we're making distinctions that aren't different. We have an asset allocation to global equity, and we have a policy that allocates among U.S., international, and emerging market. Now, either you're saying we should not reconsider our policy about U.S., international, or emerging market, or you're saying we're going to consider those same three buckets as in two steps. Can you explain to me the difference?
It's 2 steps.
That's where we differ.
Right.
We deal with it. There's the strategic level where you're dealing with big macro risks, like your exposure to growth risk, like whether or not you have growth risk in your fixed income portfolio and you should know about it. And I'll talk about that on this chart in a second. The second step is dealing with, there's the policy level where you're dealing with those big issues. Then there's the second step where you're dealing with the more granular issues like you discussed. 2 steps.
They're both policy level decisions that this board has made in the past.
Correct.
That's correct.
So, I'm not following.
So one, Tom, let me see if this helps. In one case, you allocate in the overall investment policy so much to global equity.
Right.
Then you have a global equity policy, as you pointed out, is made in a separate decision of, okay, within global equity, how much do we put in the U.S., non-U.S., and emerging markets? We wanted to review that every 4 years, but we've been kind of thrown off that schedule. But the idea was about once every 4 years, you come back and review your sub-asset allocation. An example would be we fixed weighted U.S. and non-U.S. If we just did to global equity, we would probably follow the market capitalization of the globe.
Right.
Makita would have us say, you know what, don't pay attention to the market capitalization, pay attention to the risk-return characteristics. So as they tried to point out, their model would probably favor emerging markets much more than just a market cap exposure, which is what we have now.
Okay, I mean, that's a whole
And they
other-
would do it, yeah, they would do it up at the investment policy level, and then global equity would automatically reflect that. PCA, our history has been, you said it at the investment policy, and then later on at the global equity, it would be a different investment committee's decision to then say, oh, within global equity, what do you optimize it sort of within its own world, rather than optimizing it in relation to the overall asset allocation.
So I
Neither
guess-
way is right, neither way is wrong.
Yeah, so I think the real question is, what's the advantage of having the two-step process, particularly if we don't get to the second step?
Okay, well, not getting the second step is well above my control, and that's your decision. And in the
Well,
past,
let me put it this way, we haven't done the second step in like 4 years.
Right.
What's wrong with doing both steps at the same time now?
it becomes a philosophical decision, and that is you believe that the assumptions being used for these multiple asset classes have a level of precision and accuracy that you can rely on.
Well, we have to do that at some point anyway.
And the broader and more general those numbers are, the less you're letting an optimizer basically make your decisions for you. And at the end of the day, when you use the optimizer, what's going to drive the decision, in fact, is constraints. And each asset class will have a minimum and max, because if you didn't use minimum and maximums, you would end up with illogical results. So in fact, the optimizer doesn't solve the portfolio. What solves the portfolio is how you establish your minimums and maximums, because given today's assumptions, unconstrained, the model would have no fixed income and would have an unbelievably large exposure to private equity.
Yeah, that all apart, I mean, I get that, and frankly, given where fixed income markets are and the size of our allocation to fixed income, the dialogue, in my mind, changes a little bit. But in terms of the number of categories. But as to equities, it seems to me it's the heart of what our committee should be doing, is to be taking those two steps and engaging with staff and having a comprehensive view of how we want our equity allocations to be set over the next 4 years.
We don't disagree with you, Tom. We're just saying, given this approach, is you do need the second approach, and the second approach should be much more detailed and much more granular than you get into when you do strategic asset allocation.
Well, I guess that's the definition of it. Yeah, but, okay, I think we're,
I don't want to get any more.
I've asked.
Joy?
So I did just want to follow up on Tom's question. So if we manage this in a way that took the two steps that we're talking about, the set of data that we look at to make decisions on the second step, is that the same kind of sets of data and assumptions that we look at in the first step, or is it a completely different?
In my experience, it's a much broader and robust analysis because you have the time and the resources to really dig into each one of these broad asset classes to look at the risks, returns, the opportunities, the management styles, the costs. And each one of those could take a whole session or multiple sessions, which you really can't do given strategic asset allocation, where you have to go through it and it's already complex. You'd bring levels of complexity which we feel are impossible to deal with in the time frame that we're looking at. But I think Tom raises an interesting issue. Even if you go through the two-step process, you probably won't end up with something that's dramatically different using the different models. I mean, the big issue is how much equity exposure you're going to have. That's going to dictate. It's not if you're 3 or 4% higher in one of these or the other. And then you're parsing out something which the statistics are unrealistic. I don't know if you had the chance to look at one of the tables in there, but it shows the amount of error in the forecast in the consulting community. Sometimes it's off by 400 or 500%. And the more granular you get, the more wrong it becomes because those errors compound upon each other. And there's not a right or wrong here. We would think you'd want to spend more time as opposed to a finite time getting into the merits of the broader growth class on how you allocate within it. And that's what we're recommending.
Chris wanted to chime in.
I just want to add, keep in mind, we're not asking you to pick between them. I think you're picking up how hard and complex. We're going to run both models parallel. But I love the questions because you're getting at the finite differences between them. And this is what you wanted. You wanted two consultants. My analogy to Sharon a while back on the phone was, it's like going to a doctor. One says, I'll fix that by operating, and the other says, I can fix that by physical therapy. And neither one's right or wrong. But boy, and that's when we realized we can't make you pick between them. It's too hard. The one example I give you, Joy, is in fixed income. We have a 10% allocation to high yield. That's because that's how big the high yield market was within fixed income back when we set the policy. And we haven't had a chance to revisit that for a while. The percentage of the market might have grown or shrunk, but that would be the kind of thing that one would have optimized it, might end up at the same level. The other would, we'd have a bucket. So but I think important thing is neither one's right or wrong. They're just different ways they go about it. And so I'll leave it back to you to keep asking questions.
Go ahead, Neil.
Just one continual additional add-on. If you go to INV 64 and 65 in our report and you just flip back between the pages, one has a series of boxes on them. They're empty, and they're big boxes. And there's another page in this PowerPoint that has them, but they're there. There's basically, we're saying you're allocating your assets among 8 boxes. And why are we doing that? To try to solve on the asset side of the CalSTRS balance sheet, to try to figure out how to structure that balance sheet to best resolve the major goals and concerns for the entire plan out for 20 to 30 years, maybe even longer. Now you go to INV 65, there's a lot of granularity there. The question is, how much of a difference does it make to analyzing the fund, the balance sheet to go granular? And the basic point is, it doesn't make a lot of difference to go granular. Really what we need to focus on are the allocations among those 4 boxes. And that's really what makes the big difference and the big driver in the success of the plan. It's not whether or not you have, like within just one of these boxes, stability-oriented public income, where we got bank loans, interest rates, MBS, tips, and global fixed income. We can have different allocation mixes within that box, and mess around with those. But that's just so marginal, it doesn't make a big difference. And from a strategic allocation perspective, a big policy perspective, it's really the key is to focus on those, in a sense, allocating on those 4 boxes, across those 4 boxes in INV 64. And that's how you can really drive differences or look at how the impacts of allocation are going to drive a difference.
Yeah. So I get that line of logic really well. And I imagine it really depends on what buckets we're talking about. But it seems to me that one of the big drivers of our performance and our successful performance has been the native bias we have and overweight in U.S. equities over the past couple of years. So you're and that's probably more important in our returns than the percentage of equity versus debt or infrastructure, or within debt categories, infrastructure and tips or something like that. So are you saying we shouldn't pay attention to that now? It's I think, been our biggest successful performance driver.
It has been. We can't deny that's the fact.
Yeah.
Now the question is, what's the attribution of that driver? Is it equity? Is it the equity premium? Some of it is,
Yeah.
but a lot of it's currency.
Yeah, okay.
Okay? And that's not something that none of us have talked about up to this point, is the currency effect. How do we manage the currency risk in this portfolio? That's a great question. Neither Makita or PCA has really come up with a specific, explicit idea for that. But that's, if you look at, and it's a flight to the dollar, and that could reverse in the next 10 years. And that's typically what has happened over, if you look at a 40-year time frame of U.S. versus non-U.S.
Well,
That's
I
typically
know,
what
but I mean,
happens.
it just seems to me that it's probably true for some segments of the balance sheet that we should talk about larger aggregates. But we're talking about roughly a third of the balance sheet with each of those two. And whether it's 32 or 30 or 35 and 30 or something like that, has made a big difference to us. Now, somehow I think we should be explicit on our allocation there. Maybe I'm wrong, or maybe you can give me a better reason why we shouldn't.
No, we think you should be explicit. We're just saying the time to make that decision, because in fact, for the first time in PCA's recent history, we have expected returns for asset and sub-asset classes. We think that non-dollar assets will perform better than dollar equities in the near term. We don't build that into the model. We think that's a separate decision. In fact, we would probably suggest, when you review global equity, that you increase your exposure to non-dollar assets. But using this tool
To do that.
to accomplish that objective assumes a level of importance for the difference that's not there. What affects both of them is growth.
Why aren't we using a whole set of tools instead of just one here?
I'm not sure I understand the question, Tom.
Why aren't we using, besides the macro allocation tool you're looking at, why aren't we using analytics you would bring to bear in the next step of the
Second phase.
Yeah.
That just becomes a question of timing and resources and how much the committee wants to spend getting into, in quote, the weeds within each asset class. And that's a judgment call.
And going back to Alan's point, there's a table in the report that shows, with respect to the two subclasses that you're talking about, U.S. equity and international equity, we're pretty lousy forecasters. We don't know. I mean, the error is for U.S. equity. If you go back and look at the industry's 10-year forecast going back to the early 90s, and then looking at the subsequent results 10 years later, the error's off by a factor of 5. If you look at international equity, the errors are off by a factor of 100%. So we're not very,
market weighting, or?
but we're not very good at even telling which one's going to be better or worse for the next 10 years. So if you want to, if we want to use these tools, which really magnify the error if we're not careful, to make allocation decisions like that, through experience, and that's why I like the Julia Child experience quote, because we all resonate with her because she really became recognized when she was 50 plus years old. So she had a track record. She's speaking from experience. We're speaking from experience. The models can only decipher so much because of the amount of error we're sticking at them.
Okay.
All right, I'm going to move us forward. Do you
Okay.
have more?
Well, the point here is on this slide 13 is these are the classes we're going to use. They're different than the ones we had before. One of the key features is in fixed income. We're going to split fixed income apart because based on the observation that was made about equity risk, there is or growth risk, sorry, you can experience growth risk within the fixed income portfolio. In addition, fixed income is, really being revisited based, versus its traditional role of producing a decent amount of income. It's very hard for the standard fixed income portfolio to do that. So a reasonable way to look at that is to break it apart and say it has two major segments: credit, where you're really pursuing income, but recognizing that piece of the portfolio is exposed to growth risk. And so that's what we're doing by pulling it apart. So you're not surprised by that, but actually explicitly recognizing that. Then there's another piece of fixed income, what we call interest rates liquidity, which does have interest rate risk, but it's really there to provide safety to the portfolio. So just breaking those two apart. So that's one of the bigger changes that we propose that we'll model versus the last time we did this. And then the other two colored boxes there are, absolute return. We talked about that in the last asset liability study. It has an strategic allocation of 0. We're not going to even model that anymore. In its place, I think staff, Makita, PCA believe that there is another solution set. We all have a little bit different version of it. We call it crisis risk offset. And it's basically a class that is going to respond well when the equity classes are not doing well. And we think it's worth, at this point, the key is to get it into the modeling process to examine it. It's not necessarily to approve an allocation, but just to study it hard because we think it warrants research and a look. And so what I want to do is just for 1 minute, just pass it over to John Linder, my colleague. Yeah, 1 minute.
Go ahead, let John, Tom wants to jump in, and then John, feel free. Couple
So,
minutes, sure.
just, and maybe I'm reading too much into the chart, but you switched the terminology from global equity to global growth.
Yeah, that's right.
Is there
there a
some, what lies behind that?
We even bolded the word growth, so we're not trying to
No,
do a back end on you guys or anything.
No.
What's happening with your portfolio, and this is something that's evolving in our space, is that you have a lot of interesting different looks of how to structure equity portfolios. And there's a couple of buzzwords that are being tossed out in the marketplace. One is smart beta, you might have heard of that. Another one is like low volatility, you might have heard of that. So you have your innovation team right now, they've actually funded, as Chris mentioned, they funded several of these types of strategies. They behave not like, they do not behave exactly like the standard global equity class over there that we've modeled in the past. They behave differently. But we want to take into account that you could have these types of strategies that do reflect orientation towards growth risk, but they do behave in a complementary fashion, and that's what's going to be in a global growth class.
Tom, if you could go to INV 65.
Okay.
And what that does, it gives you the different boxes, as we call them. And if you look at growth-driven, And in fact, you have a series of, in quote, sub-asset classes that we believe could be growth-driven, which include converts, high yield, to a certain extent investment-grade credits. All of those, to a certain extent, are driven by growth. And the way we know that is collectively they all tanked at the same time when the equity market tanked. And so when we're trying to get diversification, we want to make sure we get diversification. Where do we get that? We get that from the stability-oriented assets, which in fact some of those did really, really well, particularly U.S. Treasuries when everything else fell apart. And that's why we changed the names.
Okay.
Because they include different things. It's not just equity. It's equity-like because it performs like equity and it's sensitive to growth. Okay, John, be quick because it's lunchtime.
Absolutely. So everyone's hungry, but we're going to talk about the crisis risk offset class that we're envisioning, that we're introducing, or believe that you should consider. This is an objectives-based or objectives-driven class. That means that well, I'm going to introduce an analogy. Okay, institutional investors like CalSTRS are like farmers. Okay, and that is vis-a-vis other individual investors and other small institutions, small funds, which are more like hunter-gatherers. Okay, you need to plant what you want to harvest. Okay, you don't just go out in the woods and try to find something to eat. Okay, I'm going to come back to that particular analogy, and that's why I wanted to introduce it. But the objective that we're introducing for this class to meet we have to give you some context on that. And that particular objective was we worked with staff, Chris and Michelle, yes, but more closely with Stephen Tong and Carrie Lowe and Josh Diedick and Glenn Blasset on this whole project of shortfall risk reduction. So we, in doing that, we indicated in order to reduce shortfall risk, you need to reduce your lowest lows while maintaining the average return of the portfolio. And so how do you do that? Well, I want to go back to my analogy. A farmer can diversify crops, but that farmer is still exposed to a single risk factor, and that's the weather. And why don't we use drought, because we're in California, okay? They can diversify their crops, but their crops are still subject to that single risk factor. So how do you diversify that, or how do you conceptually reduce shortfall risk? You need to diversify the portfolio. And how can you better diversify? Well, we looked at this portfolio and we looked at all the institutions we work with. What is the major risk of the portfolio? What is the single factor risk that all institutions largely are bearing in greatest amount? It's growth risk. So if you're going to do anything to reduce the shortfall risk of the portfolio, you really do need to work at diversifying against growth risk. Okay? Otherwise, it's not going to move the needle. So the farmer analogy, again, if the farmer wants to diversify against weather, against drought, they need to either introduce storage or livestock, okay? Introducing another type of crop is not going to help that, okay? So what actually is going to diversify against growth risk? Well, we knew that you had to be able to do it in scale because your portfolio is large and your portfolio, the growth risk is very volatile. It has to be liquid and it has to have enough impact to offset the biggest risk in your portfolio. So we looked at only things that met that criteria. And the things we came up with are interest rate duration, global treasuries, as Neil mentioned, trend following strategies, and also alternative risk premium strategies. And we won't go into the detail on how that should be arranged, but what we did in our process is we came up with things that are capable of meeting the objectives and that are scalable and have an impact or can have an impact. So this isn't something that's just going to flitter around and do nothing. It's not going to be up 3% in a growth crisis. We would expect this class to really move in a growth crisis, to have impact. Otherwise, we wouldn't be fooling around with it. So that's an introduction.
Yeah, actually, it's a comment. Understanding now what you're saying about growth and this new asset class, and then you've added credit, which I take it would be investments that change in value with credit, based on credit quality and duration, yeah. Which is, so you're really proposing in a candidly, quite imaginative way, relooking at the way our portfolio is looked at.
That's exactly right.
yeah.
It's different, and that's why I started off saying that it wasn't what you've seen in the past. It's a completely different way of looking at it, but to be humble, you might not end up terribly different than you are today.
We might own the same assets, but.
Right, but it's a different thinking process.
Yeah, so it wasn't that apparent at the beginning how differently you're categorizing things. Okay, thanks.
Rich?
So I just want to make sure I understand the process going forward. Right, we're going to go on parallel tracks for a bit,
This is information item.
right? But at some point, we're going to have to choose or reconcile or do something.
There's one area where we're going to need common ground, and that is it's going to be really important that we all use the same assumptions on the capital market side,
I mean,
because otherwise one could pick and choose, and we need to, I think it's the next meeting where we're dealing capital market
April,
assumptions.
June.
And there, we're going to come to you and ask you for your guidance on, we'll make recommendations, but you'll make that decision. Because otherwise, we'd end up with results that are totally incomparable.
So my hope is, obviously, no one's done this before, so we are trying to do this ourselves the first time. I wish I had experience to tell you, but our hope is that by the time we get to September, you'll have two efficient frontiers. Our hope is you won't be able to perfectly overlay them, but they'll be close enough you can reconcile them. And that's the key, is the inputs, because they're using our liabilities and then the same assumptions about what the markets will return. And staff is going to work with both consultants to look at their current assumptions, kind of granularly add them up and make sure either we make them all adopt one set, a CalSTRS set of assumptions, or we'll allow them to each use their own as long as they close. But you will have two efficient frontiers, and we think, I can't guarantee, but we think by the time we get to September, we're darn close, and that the shapes will be identical, and where you are will give you the choice between then a really granular set of assumptions you adopt or the more detailed. But we're trying to give you the most flexibility so that you don't have to pick and choose every step of the way between them. You'll be able to see both. You're paying for both. You'll get to see both all the way.
There's a piece of Steve's pixel analogy that I kind of like, because the thing about pixels is a lot depends on where you stand. The need for more pixels depends on where you stand. If I stand really close to the painting, I need more pixels to make it smooth. If I stand at a distance, then I don't need those pixels.
Screen.
Right? And in fact, they can be distracting. So, the analogy's not bad. I'm just not sure where the outcome is yet on that.
So,
Go ahead,
question
Tom.
I've got.
Can you chime in, Tom? Just a second.
I can see where,
Okay.
given their
Or not.
growth definitions, it's going to be difficult to homogenize capital markets assumptions unless, because you can have equity return assumptions, and you can have convert return assumptions and things like that. Now, maybe they'll express themselves at different parts of the portfolio, I guess, but yeah.
Well, I think the guidance is, we know how to do, as consultants, we should know how to do this, but if we're told, here's a set of assumptions, sort of a master set of assumptions that you will abide by, consultants, we should be able to make the underlying components consistent with that master set. And if we're given that charge, that should probably solve the problem. I have one.
Oh, go ahead, Neil. I would say, to give you a quick history, historically, I'm going to say in like 03, 6, 9, STRS, those years, STRS we adopted a set of assumptions we made the consultants use. We said, here are the CalSTRS assumptions, use these. 12, the markets were so fragmented, we said, let's do a survey of all the consultants, and we brought somebody in who did that. And then we adopted PCAs because we found them reasonable. And so we'll decide by your June agenda, we'll either make it an action item where you've got to pick a set, or we'll let you know that we can make it an information item, and we can use both of those because they're close enough, we think they'll work well.
Okay.
I haven't checked with Chris, just for you, Rich, I know, just to kind of let us know again what the process is each step of the way, so that every board meeting we can anticipate what are we doing in the next board meeting as an information item, action item. And I know that, Chris, there's an inclusion of that calendar in here, but Chris, you'll keep reminding us, right? And our consultants, so we can stay on track. So Neil wanted to add something, and then I've got Paul.
I'm sorry to stand here. Chris mentions an efficient frontier. That's sort of a technical term. We want to say that what will end up happening is that we'll bring you solution sets that will deal with your notions of risk. Efficient frontier is a standard deviation and risk chart, and that notion on the bottom, the standard deviation, is very limiting, and we probably all want to look at risk in a couple of different dimensional ways, particularly when we're talking about here an asset liability study. So I just want to make that point.
Great. Paul?
Well, this last conversation is what has confused me about what I think is otherwise a very interesting way of looking at things, and that is that when I look at INV 65 and I see 8 boxes and lots of different granular asset classes within those, I understand those, but I also think that we've got lots of pixels like we have with the Makita. Mm-hmm. Then we flip over 5 pages to INV 70, and those 8 boxes have been translated or converted into something else, but it's not clear what. So
INV 70?
Are you talking about?
71, sorry,
Yeah,
INV 71,
Yeah.
That, and that's where I get kind of confused, because what you're saying is you can map these back to asset classes, which is I think what we have to be able to do, right? We have to be able to map your 7 or 8 categories here to Makita's 13 categories, and I didn't really see how we translated from INV 65 to 71, but I'm assuming that when we talk about asset classes, we will. Good.
Before I jump to Tom, are there any other board members, I just want to be conscious of, are there any other board members with questions or comments besides, we're hungry for lunch, besides that one? Tom?
So I'd like to ask both consultants to add one other dimension to what they're talking to us about. And that is, I'd like them to isolate those questions in portfolio construction or and asset allocation that have over the next 4 years, they think will have the most impact on our returns, and talk about how their approach addresses those or makes that visible. Because ultimately, we're making calls here explicitly or implicitly, and I want to make sure that the approach we take is closely related to something that says we've made calls on the right questions.
That's helpful. I guess, Tom, the one question or the one comment I have is, there's 10 of us on this board with different levels of experience doing this kind of work, and I think that as clear and concise that you can make it to help every board member on this dais understand it, because I think I just want to be mindful of, I guess I'll just speak for myself, that, I just want us to kind of stay in that 30,000 foot, and whatever guidance you can help us with would be great. But I just felt like there was confusion in the February board meeting. I guess I'll just say that. And I think this has been helpful. I guess I just don't want to,
Sure.
I don't want to create more confusion, I guess, is my
Yeah,
only
let me
concern.
clarify my
Sure.
request. I
Go
mean,
ahead.
looking back over the last 4 years, the things that have made a big difference to us is we've gone underweight fixed income. A lot of the world did. We've been overweight U.S. equities. That's been it's turned out to be a very fortunate place to be. Those big levers are the things that should be pulling out of this exercise, as opposed to a methodological argument about do we categorize growth risk or equity risk and things like that. So that I want some visibility on that and how your approach is giving us visibility on things that will
Good,
drive results.
Makita? Good? Good to go? Everyone good? I don't see anyone else in the queue. Are you guys okay?
We're okay.
I think we're going to break for lunch here. How's that? 1 o'clock. We'll have a half an hour.